Commodity prices are determined in open, competitive markets where willing sellers interact with willing buyers to strike a deal where timber volume is freely exchanged for money. This is the standard of competitive markets fueling the exchange of raw timber commodities. As the Great Recession pivoted to an expansionary mode late in 2009, I took the challenge to make predictions of how timber commodity prices would rebound. I asked myself, what would be the path of price appreciation for timber logs entering competitive marketplaces? It took mathematical formulation, macroeconomic theory, and wetware to realize these events. Wetware refers to the human element within computer systems, economic theories, and practical experiences to explain the world we live in. The Real Price Appreciation Forecast Tool, that is the RPA Forecast Tool, was minted into use in 2010 to become part of the Forest Resource Analysis System software, FRASS, as it became a critical component of how forestland valuation is articulated, one timber stand at a time. The process gives specific attention to competitive market prices. I launched an online FRASS demonstration site to become the genesis of results. 10 years of continuous data processing and the integration of these procedures into other markets made this process clear to the most critical evaluatory hurdle it could. I had to first prove it to myself. I put the RPA Forecast Tool procedure into print for the Journal of Forest Policy and Economics, where it was reviewed and accepted for publication in April 2020. I present this to the Western Forest Economists meeting, 8 June 2021, to share it with the world. People can get the journal article from the publisher, Elsevier, or visit the Forest Econometrics website to find it in the Print References section where this article is found as a PDF. In this video, we explore the financial forecast portfolios created to apply to timber transactions. This builds the analysis protocols from its foundation upward to the financial optimization pinnacle. You can read the article for the details of this process. In this video, we will focus on the benefits of using this approach and what it reveals for your financial management approach. Commercial forest land owners will ultimately sell their timber growing on their forest lands. When they do, each makes a decision of entering a stumpage timber sale or a delivered log sale. The difference between the two is significant. Stumpage timber sales transfer ownership of standing trees to a buyer. The buyer will harvest the trees, merchandise them, place them into sorts and grades, and deliver them to willing buyers, generally lumber mills. The stumpage timber sale buyer decides who will purchase their timber logs, and your buyer will receive payments from the lumber mill. It is the responsibility of the stumpage timber sale buyer to settle accounts with the forest land owner and to complete administrative requirements for things like reforestation, wildfire abatement, and post-sale logging road stability. The delivered log market sales involve the forest land owner hiring a logging operator who will harvest the trees, merchandise them into sorts and grades of the forest land owner's selection, and deliver them to buyers selected by the forest land owner. The forest land owner will receive payments directly from the mill and settle all accounts with the logging operator, and meet regulatory requirements imposed by administrative authorities with jurisdiction. In this discussion, we will reference specifically the delivered log sales scenario to focus on how timber commodity price trends are forecast within specific markets. This approach gives attention to timber logs placed into grades and sorts within subject markets. In this world of connected currencies, we discriminate between two names, nominal prices and real prices. Nominal prices are the type of currency we deal with every day. This is the cash paid for your beverage of choice to start and end your day. This is your payment made for the house or apartment you live in. Nominal prices are expressed in the currency of now. You will pay in US dollars, European euros, Japanese yen, or Chinese yuan renminbi, but the nominal price is set the day you made payment. Because inflation is part of national currencies, the relative value or the time value of money changes with each day. This introduces the realities of real prices. We take the nominal price paid and set them to the date of transaction. Holding nominal prices set by date, we combine them with the inflationary indicator for the national economy. In the United States, that administrative board is the U.S. Bureau of Labor Statistics, the BLS. They track several inflationary indicators, but the one most applicable to forestland macroeconomics is the Producer Price Index, the PPI. Changes in this indicator give action to lifting inflation out of nominal prices to make them into real prices. Always indicate the date of real prices you use. This makes them meaningful for comparative price changes. BLS charts are continuously updated with monthly values released after about 2 weeks each month. When a recessionary trend is realized, it is called by the BLS as a gray-shaded panel. We see a minor recessionary period was called in 2001 with a drop in PPI monthly values, entering recovery soon after 2002 initiated. The Great Recession entered in 2008 to break into the following year as expansionary forces struggled into 2011 and beyond. Although indicators were evident in 2014 through 2016 to signal another recession, it was not called at the time. Currently, we push into 2021 to see a differential color code applied to the COVID-19 recession. Recessionary significance is always most important when taken one economic entity at a time. I roll these concepts into an actionable result for all forestland managers. The lower chart line shows nominal prices for Douglas fir sorted logs graded as 2 sawmill grade. This is an important grade of the most notable species for this marketplace. It is commonly milled into boards, sometimes planed into veneer, with residues passed to pulp processing. The upper line shows the same data, expressed in real terms. You will always see the real date by looking at the label of this chart to see it end with 2021-05, meaning it is from the year 2021, happening in the 5th month, or May. That is the real price date of these data. This is how we keep the real date actionable across our analyses. Keep the currency you deal with in constant terms across all calendar dates. Always look for that time-specific indicator. When we connect prices and costs with timber volumes and associated values, we allow the time factor to play out through the multiplicity of data forecast combinations projected into the future, looking for the optimal solution in terms of a synergy between biometrics and finance. We are dealing specifically with the valuable price forecasting parameters in this discussion, but no, these are only made priceless when combined with biometric parameters of tree growth. Matching biometric tree growth parameters with price forecast data makes results into actionable decision metrics. Financially optimal timber harvest timing is presented as a valuation nexus in the entire FRASS scenario. It allows all critical players involved in a value articulation, a land appraiser, investment manager, and forestland manager, to attribute the same value to the asset, which is accomplished through shared access to the clusters of well-partitioned data configuration. Regression analysis has been conducted by many for several decades to consider past commodity price changes in attempts to make market predictions. These attempts to describe markets belong in the realm of time travelers, always looking backwards to make predictions about what might happen now. The problem is, all economic forces need to identically replicate in the new scenario to mimic repetition. Regression analysis will only reveal what has happened, without looking ahead to answer why economic forces created these results. The RPA Forecast Tool uses real prices as they arrange within the Markov chain of order following a random walk. Loaded with economic slang and historic personalities, continuous time Markov chain analyses set forth by Andrei Markov around 1906 put these theories into consideration. I aligned their support of timber commodities traded in the markets of today. We are looking at Douglas fir sort, 2 sawmill grade, real monthly prices from 1989 through 2020, expressed in May 2021 real terms. We observe economic recessions called by the BLS, including the current COVID-19 pandemic cycle. As we consider these market price cycles, identify 2 critical price points in each cycle. The first initiated in 1992 with commodity prices appreciating steeply until January 1994. The result was not driven solely by macroeconomic forces. This appreciation cycle initiated about a year after the 1991-92 recession closed. The driving force behind this commodity price appreciation was straddling the wings of the northern spotted owl, as the U.S. Fish and Wildlife Service called them a threatened and endangered species. The forestry panic was to assume none of the Douglas fir logs would be allowed to be harvested ever again, spurring purchase of timber from these ecosystems. The price of this sort and grade climbed from $792 per thousand board feet to $1,300 per thousand board feet, expressed in May 2021 terms. The RPA Forecast Tool uses the initiation price change to the turning point price change to first measure the longevity of time eclipsed, called simply LNV, as we also calculate the real price appreciation event of this specific interchange. Script these numbers and their date of initiation to feed into the RPA Forecast Tool formula. The current market cycle was initiated in July 2006 to depart price stability to devalue through the Great Recession, dropping from $787 per thousand board feet to $452 per thousand board feet in May 2021 terms. Again, strike the measures of the LMV and RPA of this event. These are critical event transformers to articulate the path to price recovery. Now we see the RPA Forecast Tool formula. This mathematical approach to predicting price recovery does not use regression analysis. It also does not predict some of the driving macroeconomic forces. All input prices are expressed in real terms. But we are not predicting the value of the PPI through time. We track it and use the results to see where the macroeconomy takes our commodity prices. PF is the real price forecast of future commodity prices. IP is expressed in real commodity price terms and is the initiation price used in the market cycle we identified on the previous screen. In this case, we did it for two separate cycles. Here we can use the current market cycle, which started at about $787 per thousand board feet in July 2006. RPA per year was calculated from the turning point price divided by the commodity's initiation price, raised to the radical of the longevity of this event. In this instance, it was 2.92 years, resulting in 0.1729 used for this cycle's regulator. Variable t is a measure in fractions of a year from the initiation point to the date being considered. To apply this to May 2021, it would need to count from July 2006 forward, showing 14 years 11 months, or 14.83 years. That is the t-value for this calculation. The concluding multiplicative exponent recycles these variables to serve as a regulator to price level recovery. We could talk about the process for hours. Instead, I recommend you read the journal article to see how these forces serve the trend line of price recovery. Within this example of the July 2006 through June 2009 market evaluation event, we insert the initiation price of $787.47, passing to the RPA rate 0.1729. Now enter T for the time since July 2006 to May 2021, 14.83, entered in the baseline of this equation and again in the numerator of the exponent of 2. Finally, we slide in the longevity of the disruption event, or LMV, as 2.92. Process these through this matrix to find the delivered log price of $762 per thousand board feet, predicted for May 2021 deliveries. The last reported market price for this commodity in May 2021 was $775 per thousand board feet. This prediction was made 10 years ago and misses by less than $13 per thousand board feet. That is less than 1.7% off. I think I may have your undivided attention right now. You might imagine the reactions I received as I shared this analytic approach with my colleagues at the annual Western Forest Economists meeting. I first shared these findings at the annual meeting in Missoula, Montana in 2011. I described the features of seasonal market fluctuations, market shocks, random noise, and price shifts and trends. Those are not predictable within this approach. I show the market trend and cycles. These events are best realized when looking at multiple cycles of Douglas fir two-saw logs. We analyzed the 1992 to 94 disruption event, appreciating to nearly $1,300 per thousand board feet, then devaluing to price equilibrium by 2006. This progression from its peak to price equilibrium is described by the RPA Forecast Tool results. This cycle is repeating now within the 2006 to 09 devaluation event, as equilibrium is expected by 2025. The pandemic market disruption we see now seems not to be the disruption of this commodity's value. That imbalance initiated in 2018, about a year before COVID-19 spread through our countries. It seems the current market recession may not be an economic recession at all. That is not within the RPA Forecast Tool's arsenal of predictive measures. That is application of more wetware analysis. Statistical analysis of this tool's approach to these markets use the autoregressive integrated moving average, ARIMA, analysis to express how closely predictions track actual market data. 2 prediction intervals were placed around these predictive values, one at 90% and the other at 60% intervals. No values passed the 90% predictive intervals, meaning the RPA Forecast Tool prediction estimates were efficient at this 90% predictive level. Tightening this realm to the 60% predictive interval, approximately 89% of predictive prices were within the 60% interval in the 1992 to 94 cycle, while 87% were captured from initiation in 2006 through May 2021. This predictive tool would be considered efficient and unbiased if 60% of the estimates landed within this range. But the tool surpasses these criteria, with over 87% landing within this realm. Conceptually, this predictor is super efficient and unbiased. Delivered log price forecasting is elusive due to unpredictability of log market behavior. The RPA Forecast Tool was designed in FRASS as a reserve price indicator. Expressed in real terms, it applies to growing timber assets, referencing their financial value every step of the way. It allows analyses of broad projected data fields extrapolated from these initial settings to develop optimal harvest timing combinations. It all pivots on forecasting commodity prices into the future. I've spent our time looking closely at one sort and grade in the Western Washington delivered log market area. In this marketplace, Douglas fir logs are bifurcated into 5 grades. July 2018 price predictions gave indication of the market performing above predicted levels. This is the use of the tool as a reserve price indicator. When the price is high, make the logs fly. When the price is low, let them grow. This happened in the second half of 2018 and through 2019 and through to current time. Use the prognosticative value of this approach to recognize that macroeconomies are constantly changing, and therefore, so are all the currencies we use. It makes your anticipatory market changes into market timing values. We have changed the analytic approach to the sawmill and better grade of the Douglas fir sort. This cycle started at the same initiation and turning point dates, but the commodity prices were different than we saw in the 2 sawmill example. Repeat this analytical approach for all sorts of each timber grade, and see where prices are expected to settle through time as expressed for monthly deliveries. Oftentimes, analysts will recognize complementary species prices as adverse in price responses, like when high-quality logs in the SM and better or 2 sawlog grade are high. The competitive price for pulp of the same sort will decrease. Mill residues are high when sawlog prices are up, so the need for more pulp logs is lowered. Pulp prices devalue. Conversely, when high-quality log purchases are low, mill residues are lowered, and the need to purchase more pulp logs increases, dragging pulp prices up. I have used this approach when dealing in international timber markets. I first did this in 1996 as I was CEO of a US-Russian joint venture harvesting timber in the Russian Far East and selling logs in Japan and South Korea. These exchanges were expressed in the representative country currencies, but the predictive effects were the same. Today, I do it in US dollars, knowing they are trees growing in the USA and purchased for delivery to both Japan and China. This is the export grade of Douglas fir and western hemlock logs. These foreign buyers are more attuned to commodity price trends as evidenced by the prices they strike on these competitive markets. They experience fewer market shocks and inadvertent random market noise. We transitioned to western hemlock, internationally graded as export 12 inches and greater and as 8-inch to 12-inch small in diameter. In the USA, all export markets are scaled in metric lengths, even though their small end diameters are expressed in inches as consistent with US measures. The realm of delivered log commodities needs to be considered one sort and grade at a time, each maneuvering within the competitive markets where they are sold. A few minutes ago, I made reference to how 3 timber market participants intermix within this realm: forestland appraisers, investment analysts determining asset values, and forestland managers implementing financially optimal timber harvest rotation dates made one timber stand at a time. When done correctly, all 3 analytical participants will come to identical asset values. All other approaches leave value on the table. The RPA Forecast Tool is one of the mechanisms to determine this optimality goal. Knowledge-based value is achieved when the RPA Forecast Tool is merged into the FRASS analytic approach of commodity prices with physical site data, location-based constraints, and the FRASS analytical approach. True optimality is revealed when considering annual, quinquennial, and decadal harvest possibilities on each timber stand for growth periods of 250 to 500 years each, repeated through 3 possible rotations on each timber stand. Analytical power is provided to the investor wanting to know the financial optimization possibilities on the properties they invest their money and time into. Time is the most scarce resource we have, so make all investigations meaningful and actionable. This is where I spend my analytical time. Highly elaborate econometric forecast models of commodity price patterns have organized vast arrays of potential independent variables into dozens or hundreds of simultaneous regression analysis algorithms to predict ultimate price effects on dependent commodity subjects. There is a danger of overcomplicating analysis rigor. The KISS principle is something I applied heavily to the RPA Forecast Tool, but here I use the acronym to represent Keep It Sophisticatedly Simple. I follow the law of parsimony as put to paper in 1300 by English Franciscan friar and theologian William of Ockham Razor to guide decision-makers to seek simpler theories to explain phenomena as being the preferable approach to more complex and convoluted explanations. Independent variable parsimony has been my guiding theme while I develop the real price appreciation forecast tool approach. The FRASS approach and the RPA Forecast Tool can be applied to your property using the currency of your economy to discover asset value now and into the future. The program's databases containing property data are aligned with the country-specific market data and macroeconomic profiles. Utilizing complex algorithms, the program determines financially optimal timber stand rotation timings for the current timber stand and all stands into perpetuity. You will receive asset values discounted to current day for each timber stand, parcel, district, and the entire tenure. FRASS is responsive to your needs as it generates reports to user screens and in PDF documents. Site security and client data confidentiality are part of the system's design and implementation. Contact us at the email shown here to arrange a no-cost demonstration of the program and receive guest access to our demonstration site. Enter FRASS on your own to explore how it fits into your financial optimization profile.